Good afternoon, and welcome to the Boring Millionaire podcast. In today's episode, I want to discuss what we saw in the stock market over this past week and where I believe we're headed. So today is Tuesday, September 23rd, but I'm going to start by going back a week and a half to Monday, September 15th, where we did see the S&P 500 break an all-time high of 6,600 for the first time. That following Tuesday, it did go further into record territory. And then Wednesday the 17th, we did see a little bit of bouncing back and forth, given that we had a Federal Reserve meeting. It was a positive Federal Reserve meeting, given that they cut interest rates by 0.25%, which the market already priced in for most of the month of September. But again, it was a reiteration of the positivity surrounding the market. So overall good news for everybody, which means overall good news for the stock market. So then we saw Thursday and Friday, and as well as this past Monday, we saw just further rallies into record territory. Then today, Tuesday, September 23rd, we did see an all-time high hit of 66.99 on the S&P 500, where we did start to bleed into the red, and it did turn down to a 0.5% down earlier in trading. Now, granted, it's around 3 o'clock right now, so I didn't see the closing prices, but before I started filming, the day did turn red, and we did see negativity in the market. So I have been watching the market over these past 2-3 weeks, and I do think we are priced in a little bit over our heads. I do think there was a lot of optimism ahead of the Federal Reserve meeting, and granted, yes, they did cut. I do think we were just a little bit ahead of our expectations for it. So they did do a 0.25% cut, which is good, but it quite frankly is the lowest they could have cut. So yes, they did cut, but really not so much. Granted, I'm not trying to contradict myself. It is a positive for the market, but I do think we are a little over-optimistic, and I do expect some choppiness in the market over the next couple weeks. Now, when I say choppiness, I just mean kind of sideways trading. I think we're going to go down a little bit. We're going to go up a little bit. We're going to go down, go up, kind of back and forth between really a 6,500 and 6,700 level on the S&P 500. Now, I keep saying the S&P 500. What the S&P 500 is a benchmark for the market average. It is a grouping of the 500 best performing stocks on the market. And with that, it creates an index which is used as a benchmark to basically follow the performance of the stock market as a whole. So with that said, we have been breaking further and further into record territory, but I do suspect that maybe there's a little bit of negativity looming in the background. Now, one thing that is indicating that to me is the volatility index. The volatility index is basically the fear factor of the stock market. And even though over the past 3 months, the stock market has been continuing to rally into record territory, the volatility index is starting to raise as well. So as the market goes higher, the volatility should go lower, but there became an influx point where now the market continues to go higher, but volatility is going higher. Fear is raising, animosity is raising. So that to me leads, although that the market is doing well, there's something we should maybe be a little timid about. And I would also like to say another indicator showing me that maybe the market's going to take a little bit of a pause is that a lot of the gains we've seen in the S&P 500 have come from 3 major companies. Now we had Apple, Alphabet, which is Google and YouTube, and Tesla over the past 2 to 3 weeks have just been killing it. So granted, these are trillion-dollar market caps. These companies are worth trillions and trillions of dollars. So with that said, these astronomical moves add so much money to the stock market as a whole. So where I'm getting at with all that information is I do believe that a lot of the rise in the stock market as a whole came more so just from these 3 particular stocks and less from the stock market across the board. So kind of like a psych out, it's making you think the market's doing better when it's really these 3 companies doing better. So between all that and the volatility index, I do think we could expect some choppiness, some wavy waters, but I don't think we're going to see a massive decline like we did in March or April of this year. If we do see the market slow down, I do expect it to fall to around 6,500 because that is what the trading analytics are showing me. Trading analytics are basically the nerdy chart stuff that people look at to kind of try to figure out what direction a stock will be going in, how low it'll fall, or how high it'll rise. So with all those things said, I do expect that if we see a fall on the market across the board, it'll land at around 6,500 on the S&P. The 3-month average on the S&P is 6,450. So again, kind of the same ballpark. And then if we go lower than that, our next stop would be 6,300. So again, invest with caution. You can't always invest for an upward market, but simultaneously, you can't always wait around for a downward market. So my advice is to always play both sides. If you feel like the market might take a little bit of a dip or might take a little bit of a pause, just invest cautiously, as well as don't panic and sell out of everything. So my advice, if we do see some choppy waters over the next 2 to 3 weeks, invest in the companies that you like while they're down. You could invest in the market overall while it's down by investing in the UPRO double weight ETF. And what that will do for you is invest your money in the general stock market across the board, and you will have that asset to hold as the market goes higher. So let's say we see a 3-4% dip next week in the market. If you're not sure what stocks you really want to pick, what you could do is buy that ETF, and then that way you're still putting your money in the market so that when it turns around and continues grinding higher, which I believe it will, even if we do see a decline, it'll be very short-lived. That ETF is a way for you to put your money in and gain when the stock market gains. So with all that said, I expect a little bit of bumpy water, but I'm not steering away from the market. If you have any further questions about where we are with the stock market or what you should be looking at in this market environment, feel free to reach out to me on Facebook, Instagram, or Threads. And you could find all episodes of the podcast on YouTube, Spotify, and Apple Podcasts. My mission is to make you feel confident about your money so that you could start investing in a better financial future for yourself. So thank you for tuning in, and I'll see you next week.